with us Leo Grohowski, the Chief Investment Officer at BNY Mellon Wealth Management. Last month, he told us stocks are reasonably valued. Since then, we've gotten a slew of disappointing data, including today's report on home builder confidence falling to a one-year low, and we've gotten a mixed bag of earnings. Leo, let's start with you. You said equities are reasonably priced. The S&P has gained over 4%. What do you expect going forward? Because the economic news has been sort of taking out our kneecaps here, no matter what the earnings look like.
I think the economic news has been trumping the earnings news up until this point. We haven't had much earnings news in the last couple of months. The concern is about a double dip and what a double dip might do to earnings. So we feel pretty good about our $80 number for this year's S&P earnings and 90 for next year. But with the concern growing that we might be in for a double dip, earnings visibility is key, and I think a lot of investors are just nervous about that. So
that's a good point. I mean, I think it is all about visibility again this earnings season, Leo. I mean, do you feel like from the companies that have reported so far that we are getting decent visibility?
I think we are. Decent's probably the right word for it. I think so far you've got nearly 80% of the companies that have reported have beaten expectations.
With 80% to go.
I don't think we should extrapolate that. I do think it will be the type of quarter where 70 to 75% of those companies that report will report better, and we will have a quarter that's probably an up 40% quarter versus the same quarter last year. The problem is a lot of what I just said is baked into the market, right?
Well, and it's bottom line, right? I mean, they're numbers that can be easily massaged as opposed to revenue numbers.
I think you are seeing the companies that can gradually put through some price increases, right, while having already taken advantage of a lower cost base. And we saw that from some consumer companies. So I think this is all about the market resetting its expectations, and valuation is reasonable. Some would argue it's actually even cheap.
Hey, Zara, breaking down energy and technology, are those two areas of the market that you like at this point?
Yes, we're overweight both sectors. Both sectors have underperformed year to date. Both sectors represent to us the way to participate in economic improvement. So we have to be careful because we're employing what's called a barbell approach. And at the other side of that, I think you still want to own some consumer stocks that are more on the defensive side. But energy and tech both underperform. Energy, high single-digit PEs for a lot of the stocks in the sector.
You say this, though, banking on an economic recovery or more economic strength. Yet earlier you talked to Matt and I kind of about the potential for a double dip.
Oh, yeah, but that's not our forecast. We would ascribe less than a 10% chance of a double dip. So we're not in the double dip camp. Okay. Our expectation is for growth that could come close to 3% this year and probably 3 to 3.5% next year. So energy is a good sector in terms of valuation. And tech, it was mentioned earlier, just a lot of cash and some very healthy looking balance sheets.
Hey, Leo, it's Dominic here. I mean, a lot of people have been talking about this growth story. A lot of banks, a lot of analysts down, kind of ratcheting their expectations for GDP. That's one of the reasons why that 10-year Treasury bond is yielding 2.95% right now. Is that going to be an indication of what we could see going forward? Years and years of no inflation or possibly deflation?
I don't think it's going to be years and years. I think it probably is going to be months and perhaps quarters. I do think that most market participants are taking their cue from the Federal Reserve itself, which last week lowered their own estimates for GDP growth here in the U.S. to a range of 3 to 3.5%. We've lowered ours this year to 2.5 to 3%. So I do think we also have, it should be pointed out, a leading economic indicator number this Thursday. And combined with this week's housing numbers, right, there's a lot of focus on earnings, but the economic news could be challenging because it's about housing and leading economic indicators, which for the first time in 15 months are probably going to post a negative print. So that's not until Thursday, but as you look at the week as a whole, it could be a challenging week offsetting the earnings news.
What do you think about the housing numbers, and how key are they in showing you how much we've deleveraged or how much we've still got to go?
I think it shows the latter. We've been calling for sort of a sawtooth pattern around the bottom. So we do believe the housing market has bottomed, but there's an awful lot of hidden inventory out there, and we're starting to see that with the expiration of the tax credit come to fore. So, it's not a robust recovery that we're going to see. And to your point, one of the major headwinds here is the consumer and consumer deleveraging, which still needs to take place. Debt as a percent of disposable personal income doubled over the last 25 years. We've only begun to work that off, and a lot of that was tied to housing. Right. So that's one of the longer-term headwinds that's going to keep a lid on growth.
Hey, we do want to say thanks to our guests here. We've got to cut it short a little bit, but Leo Grohowski, thank you so much for coming in again. We appreciate it.
Pleasure.